There are many different degrees of how applied or how theoretical things are, and I think this is very beautiful.
Welcome to the Knowledge Archives podcast. We're a group of students on a mission to learn from as many different disciplines of knowledge as possible. I'm your host, Madhav Malhotra, and today I'm lucky to be joined by Diem, a PhD student at the Vienna Complexity Science Hub in Austria. His work focuses on studying banks and the risks that they take. Specifically, he models the least risky ways for banks to do business with each other. I'm very excited to learn more about this intersection of math, computer science, and finance today. I really appreciate you taking the time to join me because I think this podcast will let us really explore new insights for a lot of the listeners. But first of all, I'd love to hear a little bit about your background.
So my name is Diem. I'm somewhere between complexity science, network science, finance, and economics. And I'm doing a PhD at the Complexity Science Hub Vienna at the Vienna University of Economic and Business. How did I get here? It was really 12 years ago in the financial crisis. I was really affected, or not physically affected by it, but it was all over the media. We covered it in school, and I really got interested. How do these financial markets really interact? There are so many different products, different agents, like banks, funds, they were selling different products to each other, and it was everything very disentangled when you read in the news about it. And I wanted to better understand how do these financial markets work together. And then I studied finance and learned that it's good to have a strong set of quantitative skills like programming, math, statistics, to actually investigate these topics with real data. And then I got to know the field of systemic risk research and network science. And this drew me really in, and I wrote my master thesis about it and then continued with my PhD in this direction.
Yeah. Could you quickly explain what those terms mean?
So with network science, we have different agents, those are the nodes in the network. In our case, those are banks or funds or hedge funds, and they're linked together. And they're linked together in many different ways, with the financial system, it's really through financial contracts. In social systems, it can be friendship networks. And complex systems is really about complex adaptive systems. So usually it's a network which is changing over time, growing over time, the interaction patterns change. And one of the key features is that the individual interactions between agents, they make a bigger pattern happening. And this changes the system overall. So the network can fall into a different mode when enough agents do something, or one specific agent defaults or something. That's in the financial context. Always we're interested, how is the system changing when one of the nodes cannot perform its function anymore?
When we think about the best way to explore some of that might be just to first of all hear about some historical examples of how financial risk, how that has played out in the real world.
Mm-hmm. I think the financial crisis is a quite great example because it really happened because everything was so networked. As many people know, it started out with this property boom when people took out very leveraged loans. So they really took out a loan without having any money set aside. Usually, when you get a loan for a house, the house should be worth a considerable part more than the loan. And back then, house prices were growing. So banks thought, hey, it doesn't matter if people do not have any buffer aside. So they just kept on lending. And one peculiar thing about it was this securitization, it was called. So the banks who gave out these very risky loans, these subprime loans, they packaged them together. Imagine you take 1,000 loans and you put them together as a more or less opaque financial product. And they said the overall thing is pretty safe. And then they sold it on to other agents. So those other agents were like banks or funds in different countries. And when the whole thing started to crumble, so when people actually could not pay back those loans anymore, those packaged loans, they were everywhere kind of in the financial system. And then suddenly, like, they started to really have losses, even though these assets were thought to be super safe by many of the people and institutions who bought it. There was not too much information known who has how much of that stuff. So if you were two banks, and usually you have a business relation with each other, so you frequently lend or borrow to the other one, but then you figure out, they might have like a huge package of this risk lying there, but we don't know how much it actually is. Do we really want to give them still our money? And then this started to interrupt this interbank lending.
Yeah. It sounds like the network was based on the banks in different countries, and each bank was connected to its own network of customers who would take out loans. But especially in the US, since a lot of these loans were risky, the individuals as nodes in the network, they suddenly couldn't pay back their money. So then the banks as nodes in the larger network, they couldn't get any money. And when they started packaging these loans into larger securities and sent them, say, to a bank in the United Kingdom or a bank in India and so on, now those banks couldn't also get their money. And with the flow of money now stopping between so many nodes of the network, there was lower trust. People didn't know if it was risky to do business with one node or the other. And it really stopped the linkages, which were the transfer of securities and other financial assets.
Yeah, I think that's a great summary.
So if you were to think about this, now, for most people, they will have heard about this like you first did, just hearing about it in the media. And that is a little bit of a, I guess, qualitative way to explain the entire situation, but you kept on mentioning how the quantitative side is important. So what do you mean by that? Why is it important to analyze a situation like this in this network with quantitative data?
So there are many different aspects, let's say, of the whole problem, where with quantitative knowledge, you would understand everything much better. One thing was that everyone always said it was not possible to know that these packaged loans were super risky. But if you have like a more or less good statistical education, then you see how they can be very risky if you put the correlation parameter. So how correlated are the defaults of individual loans? When you package those loans, they get a price. And this price was super sensitive in these pricing models to the correlation parameter. And if you know about that and you do a bit of a sensitivity analysis, you see immediately how much more losses could be produced if someone guessed that parameter wrong in the initial assessment of the price. So in that sense, a sophisticated institution like a bank, if they have the right quantitative skills to question what they are buying, and they can play around with this parameter, they would see that, hey, if this counterparty made a little mistake, I can have much more losses than I actually read in their advertisement material. So this is on the individual level. If you buy an asset, it would be very good if you have the right quantitative skills to assess if the asset has the right price. And on the wider level, on the systemic level, what would be great for central banks or like governments, knowing how these banks are networked, you can describe this very quantitatively. So if you really know how they are connected to each other, the different institutions, different banks, then you can start playing around with simulations. What is happening if this bank defaults? How is it affecting its neighboring banks? And then you can think, okay, this neighboring bank now got also affected quite strongly. It might even default. And then you look again, how are the neighbors affected? It's like playing with dominoes, but like really in terms of math and statistics. So you try to assess how risky things are based on how they are connected, and you try to simulate what is happening if someone gets into trouble. Will others also get into trouble?
So if I could say back some of what I heard there. So with the correlation parameter, that's kind of like the epidemiology R number, where it's like, okay, if one person defaults, then how many other people in this group of borrowers, how many of them will default? Is that correct?
It's not exactly like in the epidemiological models. If you assume that people default independently on each other, let's say everyone has a default probability of 1% in 1 year, then you would assume if you have 100 loans that on average only one would default, and only in very rare cases 10 would default. But if they default because of a common reason, so if there's like, let's say they're all in the same town and like some company would move away and everyone would become unemployed, then in fact, if you have such a real world connection between those loans, they're correlated. And if they're correlated, it's much more likely if one defaults that the other also defaults. And then it's in fact, if one is defaulting, you expect others to also default. And then it's like a kind of the opposite thing. It becomes very expected that you observe many more, or it becomes much more likely that you observe many defaults at the same time. But this changes the risk characteristics of these packaged loans as an asset, because it can actually suffer big losses. But initially, the people thought this basically cannot happen, like with a probability of maybe 0.0001% or so. But that was just because they assumed those things are not correlated, actually. So like this basic statistics, it's super important. If someone listens and you studied at university, don't think it's annoying or boring. Like, it's really useful.
I think it's really helpful to have that real life context, especially if you think discussing that with that quantitative knowledge, as you said, versus, oh, this loan is like medium risky. This loan is like, semi high risky, but that's what people do. Like, oh, this one's AAA rated. This one's AA rated. I can understand how that masks your judgment. And then the second thing you said was the reason why that quantitative knowledge is useful is because it also lets you predict what could happen in the worst case scenarios so that you can prepare better for them. Is that correct?
Exactly. And I think the biggest advantage maybe is for policymakers, if they can play such a domino game through, and they do this regularly for every bank in their jurisdiction, then they maybe react much faster and maybe with better judgment.
Yeah. And that's where your current research comes in studying what are good ways for banks to be arranged and what are risky ways for banks to be networked. Could you give examples, like real life examples of if you have a group of banks, what are risky ways for them to interact together?
To really boil it down to our research, we had for the country of Austria with a couple of 100 banks, but only like a few big ones. We had their connections of loans, so how they were lending money to each other. So we could empirically observe this, and there are like network measures which are able to calculate what is happening when one of the banks defaults. So basically this domino, simulating through this domino effect. And then if many banks like create big domino effects, you would think that your network is pretty risky. And what we see is like empirically, there are a couple of very risky banks, like they probably make the whole system maybe not default because policymakers would react, but it would cause huge stress on the whole system. But then there are also smaller banks who actually pose, at least according to these measures, quite substantial risks to the other banks. And what we did is kind of try to find out the ideal network. Like, how could we create a network between those banks that is much less risky? And for this, we need to know a couple of things. So each bank itself, it has like preferences for how much risk it wants to take on. And also usually what's the profit they get from that. And they have usually preferences with whom they make business. But now you could make it's more like a thought experiment. So you think, what's happening if we can rearrange these loans between the banks? So if one bank gives a loan to bank A, this has a certain risk. And now if you would say to this bank, so, hey, you should not lend to bank A, but you should lend to bank B. But then the bank B is much more risky. Then this bank will say, or let's call it our bank. Then our bank would say, hey, I don't want to have more risk on my book. What do I get for it? Like, it's not what I want. So you need to do it in a way such that the bank, at least theoretically, is as good off as before if you exchange the loans between each other. So you have a couple of constraints under which you can allocate the loans between banks to make the system safer. And now maybe I can say a few words, maybe what would be a safer system versus a riskier one. And maybe I start with a sort of worst case scenario where you have like a small bank in the province and it had like comparably big loans to like a regional bigger bank. And then the small bank in the province defaults, and then the regional bank suffers so many losses because it didn't have like enough equity or capital, it's also called, and the regulator would shut it down. But then a bit bigger bank is affected. And now if this has again like debt to the next bigger bank, let's say, you see where I'm getting it. It's like a snowball effect. And this would be, for example, a very bad thing, because you could just let this small bank borrow from someone very healthy. And if the small bank defaults, there would be no cascade whatsoever. Like the whole contagion thing would stop at stage one. So small bank defaults, big healthy bank. It has a bit of losses, but proportionate to its size, it doesn't matter at all. Then you can have another risky situation, and so banks can have like their individual risk kind of to other banks, so how much they affect the others. And then you have some which are quite risky from this already, but then they start lending with each other. And then if the lending between each other is big enough, if one of them defaults, it also makes the other one default. And if, let's say, both could individually cause like half of the system to default, now if they kill each other as well, they would make the whole system default. That's also like a risky situation you do not want to have, actually. So how we did it practically, you can really set this up as an optimization problem. So you swap along the different loans between banks under these constraints I described earlier, until you find a network which gives you the smallest amount of domino effects.
I'm going to have a bunch of individual follow-ups here. So when you're optimizing towards a goal, it's like in a real life analogy, let's say you had a selection of jobs as a worker and you were trying to pick which job gets you the most money. So there's going to be some variable with each optimization objective. But what I found interesting is you're saying there are two optimization objectives. One is for the banks. So the banks want to individually have less risky partners. And then the other is some measure of systemic risk overall. Is that correct?
So technically on the practical level, banks are usually optimizing for their own good, let's say. So like the banks try to have like what's best for them. And you're right, this might not need to be the best thing for the overall system. So this could create more systemic risk. So in that sense, we don't optimize what the single banks do, but we take what they did as given and try to optimize the overall system.
Yeah, that makes sense. I think one piece of context that would be helpful here is When you talk about the risk profile of bank, is this like a index, like 1 equals more risk, 0 equals less risk?
So I was mentioning it a couple of times already, this probability of default. The probability of default tells you how risky an agent is, like a bank or like a firm. But of course, for us, never know exactly. But what banks usually do with their customers is they observe a series of loans they gave to customers, and then they checked, okay, they defaulted and they did not default. And then they look at what were the characteristics of those customers, which led to defaults and which did not lead to defaults. So in that sense, the quantities between 0 and 1, where 1 means like a certain default, and the smaller it is, the better, because the higher the probability is that you get your money back. And now bringing this back to the banks, for a single bank, what is a proxy for this is the leverage ratio, for example, which is like the equity of the bank in comparison to the overall asset it holds. So the equity is all the assets the bank has minus all its liabilities. This is the simplest proxy you can do. And that's the one we used for our optimization problem, because we didn't have super detailed data on the individual banks.
And then when you're measuring risk on the systemic level, it would be great to hear about the actual metric you use here and a real life analogy of what that correlates to.
That's a very good point, because this was one of, I think, the bigger innovations the field delivered. So traditionally, you have these standard network centrality measures, and people developed it further. And for example, PageRank was one of these further developments. And it tried to measure in a network of internet links what are the most important links, such that you can rank them in a good way. And these were like heavily used for many different types of networks to find what are the important nodes in a network. Now, when we think of a bank network, we want to know exactly what are the risky ones, which cause like this large domino effect. And what these models now do, so we used depth rank for this paper. So this depth rank really nicely tries to take the information from accounting, which the banks are obliged to, and tries to develop an algorithm which has these accounting rules encoded into it. And with this algorithm, you can simulate what is actually happening economically. But the nice part about it was it doesn't take such a generic network measure, which comes from social network analysis or so, but it really tries to capture the economic relations between the different banks. So it tries to assess for two banks. So if bank A lends to bank B, so if bank B doesn't pay back the loan, how much is the equity of bank A reduced? And if the equity reduced, we discussed already, it's like a bad thing for the bank because it makes it self-riskier.
Yeah. So on the overall network scale, the specific metric you're looking at is this debt rank metric.
Exactly. And debt rank, in fact, you can calculate it for each individual bank. And it gives kind of the fraction of the banking system which suffers from distress if this one bank defaults. And you can play this through for all the different banks. And then you think the network is risky when everyone causes very large domino effects. And it's not so risky if everyone causes like smaller domino effects. So as a network measure, we take the sum of the debt ranks of the individual banks, and we say that's kind of the debt rank of the network.
So it sounds like we're taking the debt rank for one bank and then relating it to the debt rank of the entire network.
If we want to study the risk of a single bank, it's kind of not so simple, because if you take one bank away, the network will restructure, and that's the whole complexity about these complex networks. If you take the bank out, then the network will restructure in some other way, and the risk changes not just by the sum of the individual's bank debt rank, but it would change in a different way over the longer term.
No, so if I understand, the issue is that whenever we are simulating and we model the effect of some extreme shock, it's always a snapshot. Because
Yeah.
in the real world, there are going to be a lot of people going crazy after that and making very time-sensitive pressure changes. And especially in that condition, they're not going to make very rational, predictable decisions on how to adapt the network.
Yeah, that's one of the biggest challenge. And the other big challenge is that we only get this network data at, as you say, snapshots. Sometimes they're quarterly, sometimes they're yearly. But to actually see really on a daily basis how the network changes, you would need daily data. And then you could really study how such a real world event led to the rewiring of the system, or like to study the behavior of the banks in response to such a shock.
Yeah. Is this what mathematicians, programmers, people in your position, is this the main thing you're doing all day? Like figuring out which data do we have in, how do we improve that data quality, what do we correlate it to as our optimization goal? We already know how to use the tool, but you're more so looking at your tools and seeing which is the best arrangement of tools to apply to this problem.
Exactly. Like, I think that the last sentence is describing it best. If you ask yourself a question and you want to empirically get some answer, then you need to find the best data set, or the best data set you can access, because often this is also a problem researchers have. This network data is almost never freely available. It's mostly owned by central banks. And then you need to have a model. And the models, they are partially there, but if you get a new data set, or a data set with new features, you can also think, and that's the creative or nice part also about it, like you can think about a new model, or you can design a new model which tries to shed light on a different aspect of the problem. Or there are also researchers who are totally abstract. They don't use data, for example. They try to get a more abstract or general understanding of how risks are spreading, for example. So there are many different degrees of how applied or how theoretical things are. And I think this is very beautiful, because like some people really love to ponder on equations like for weeks or months. And some really want to get their hands on at programming and try to see how the data looks. What are the cool questions we can answer with it? And you can be somewhere in between. Like, you just need to find like the right people to work with, that you have complementary skills or the same skills. And I think that's the beauty about the research.
Yeah. Would it be appropriate to use this analogy? It's kind of like mathematicians are people who work with Lego. Some are really interested in just getting a bunch of Lego blocks and exploratorily building things. Other people want to follow sets and, build the models correctly. And other people still are at the Lego factory thinking, how do we make these two blocks interact together in the best way? And how can I optimize that?
Yeah, I think that's a nice analogy. Yeah.
This is a really cool field. I guess to wrap up with, what I usually ask people is about what's next in the future in terms of either problems that need to be solved or new solutions or improvements that you see coming.
There are like so many things. Well, how shocks in the real economy are spreading. So they don't stay isolated there either. If you have a problem with one industry, it affects other industry. And now all these firms have loans from banks, from the banking system. Usually, if you don't have like the right data and the right model, it's very hard to answer. Like you have maybe expert opinions, and they can say roughly, I think it will be fine, or I think it will be medium fine, or it will be blowing up everything. But you really need good data to answer these questions. And here, more data is becoming actually available. This is a current trend, that you get like firm level data on how companies are supplying products to each other. And in the central banks, there are the data sets, whom borrows from which bank and how are the banks networked with each other. For example, in Europe, they they introduced more regulations on like reporting. And then we also have at the Complexity Science Hub like a new cool group who studies, if I don't know if you have heard about it, but decentralized finance. And it's connected to the whole crypto assets blockchain thing. So on the Ethereum blockchain, people they try to rebuild all the different financial contracts and so on the kind of Ethereum blockchain. And yeah, we have a group who will study now the financial risks coming from this part. And I think this could become important because these crypto assets, they grow at actually breathtaking speeds. And if they continue to grow like that for another 10 years, systemic risk will also come from them. And then we maybe better should be knowing how to quantify it.
Yeah, no, it's we could have another hour of discussion about that, but it's great that we have people thinking about what the future of that will be like. But I really appreciate you taking on the challenge of trying to distill like really complicated topics down very simply. That is a really, really hard skill to master. So I appreciate you trying it out.